Good morning, traders. Welcome to the Flow Show. Only 3 more Flow shows to go before we break up for the Christmas holidays. So get them while they're hot. Lots to talk about today. Big event coming up tonight. We'll see if it's a market mover or not. Morning, K-Man.
Hey, morning, Ryan. Morning, everybody. What big event? You're having a special dinner or so somewhere? I don't see any special event coming up on the calendar.
No, we've got some trade data out of Venezuela or something.
I missed that one. Sorry, mate. Yeah. Oh, yeah.
Yeah.
Okay.
Should be on your calendar. Should be at the top of your calendar. But yeah, no. Obviously, the FOMC is what we're looking at later on, and we'll give our last-minute thoughts for that one shortly. First, let's get through some of the news. And China PBOC has apparently asked financial institutions engaged in aggressive trading to closely monitor bond risks. This is all down to a bit of movement, shall we say, in Chinese yields, particularly on the long end. Officials getting a bit jumpy over there. What's going on? We're in this situation at the moment where the market keeps questioning the amount of stimulus that China has thrown already, and it wants more and more and more and more. I don't think that's necessarily the right thing to do. They have chucked a load at it already, as we know, and it needs time to filter through. It's not an instantaneous fix. You don't cut rates today and expect the economy to be booming tomorrow. But markets are going to market, and they keep taking a very bearish view on China. We'll see. They've already half promised to cut rates again next year. We'll see what happens. But in the meantime, the market's getting a little bit jumpy, and the PBOC seemingly feel the need to step in or step up their monitoring of that situation. Data out of Japan, and it looks like the weak yen is helping with their trade balance. Less of a deficit coming in November numbers. Now, I would say these numbers do jump around an awful lot. But as you can see there, exports coming in a whopping 3.8%, while imports went the other way, down 3.8%. A lot of commentators putting that down, the export side of things, down to what's been going on in the yen. Obviously, there's two sides to currency strength and weakness. One side, there's benefits for exporters. If it goes one way, then it's negative if it goes the other way. But for now, that's good news for Japan. But as I say, this could all flip around month to month. Coming over to the UK, and the big data everyone or lots of people waiting for was the inflation data. Now, overall, looking at this broadly, CPI is still sticky. Okay, we got a miss of the core of expectations, but it still went up 2 pips. CPI headline came in as expected, 2.6%. That was up 3 pips over last month. So the sticky factor there. Now, we had a discussion in our chat room this morning. PPI looking a little bit more negative on the year-on-year numbers. Input down 1.9, output down 0.6. So negative numbers there, but there is a bit of a disparity, if you like, going on here, because PPI, a lot of that stuff can be seen as, the manufacturing sector, which we know is not doing awfully well. So no surprises to see that prices are coming down on both sides. If you're not buying a lot, then prices tend to come down. But overall, inflation is still sticky, because even with PPI coming down, you look at the retail price index. So this is your consumer side of things. That as well went up 2 pips to 3.6%. So in the shops, you're still paying more. Although if you want to go out and buy some manufactured goods and whatnot, you may be paying less. But overall, these are still sticky numbers for the Bank of England, and that's been reflected in the rate odds. No cuts expected tomorrow. There's only been a slight moving around of potential cuts for February at least. There's now a 60% chance of a cut after that CPI data versus 56%. So that has gone up. The market did sell off a few quids after the data, mainly the miss of expectations. For a March cut, we're up at 80% from 69, but total for 2025, the market sees just 60 basis points of cuts. Previously, we'd been sailing around 100 basis points, so you can see that has got a more hawkish slant to it. Anyway, Kate, anything you picked out for any of that data so far?
Not really. A bit up and down. The expectations haven't materially moved since yesterday after the jobs report. So I think the market is already looking at what the FOMC is going to do, and then Bank of England tomorrow. It doesn't change their picture, does it? I mean, I think it's now the base case that they won't move. It depends on whether they signal something for the future or not. As I said yesterday, there is always that little bit of a risk on the back of that weaker Q3 GDP that we saw last week, which I think is already in the rear view mirror right now. But that Bailey comes out a little bit more dovish than what the rest of the data may tell us also. But yeah, sticky kind of inflation. Keep it as it is, I would say, for the Bank of England tomorrow.
Yeah, and still that same trade-off, or that same rock and hard place that they're stuck between over what do they act on, inflation or the weakening economy. That's down to them. Good luck to them, or not, depending on your viewpoint. We also got some Eurozone inflation final data for November, and headline CPI just came down a pip after rising to 2.3% in the flash number, so it came back down to 2.2%. That's still 2 up on last month. The core came in at 2.7, which is unchanged on the flash number and the prior number there. Don't know why. Oh no, there's the core there. Sorry, 2.7%. So all unchanged on that number. Nothing to worry about there. ECB's Wunsch says 4 rate cuts is a meaningful scenario I feel relatively comfortable with. So that's him saying another 100 basis points of cuts to come. He says, I guess we'll land with rates somewhere around 2%. Says ECB will look at inflation, wages, and the PMI. ECB's Lane says forward rates curve shows a delivering of the 2% target requires more cuts to come. No shit, Sherlock. Going back to yesterday's data, and probably the big data that we get pre-Fed is the retail sales number, which all came in pretty much okay. It was perhaps a little bit autos led, but we did see headline retail sales coming in up at 0.7%. Core sales, though, were a little bit softer than expected. As I say, there's a lot of influence, it seems, from the auto side of things. But overall, no signs that the US consumer is in any sort of major downturn. This month obviously contained Thanksgiving and the Black Friday sales, though not the Cyber Monday sales. So, as I always say, you've got to take November and December together, really, in terms of this time of year to see whether spending's been fairly good or not. But for November, pretty good. Let's see if it collapses in December, which will obviously then get the market thinking about what the Fed's going to do into next year. Canada CPI data as well. Another a little bit of a mixed bag, some up, some down, some unchanged, that sort of thing. Overall, a little bit of sideways action. Headline CPI coming in at 1.9%, so down a pip, back under that 2% mark. You'll remember that the BOC run a 2% sort of target, but in a 1 to 3% range. So we're well within range there. And then depending on what ones you want to look at, the BOC core number came down to 1.6%. Some of the other 100 million others came above expectations, mostly unchanged on last month. So nothing too much for the Bank of Canada there. Canadian swaps market sees around a 55% chance of a rate cut in January, which didn't really change much prior to what it sat during the data. Though we were pricing, if I recall correctly, about 70% chance of a cut in Jan after the last BOC meeting. So that maybe come down a little bit since then. US industrial production after that, a little bit soggy, coming in month on month down 0.1%, was expected to rise 0.3%, manufacturing as well up, but not as much as expected, turning around a loss for last month. A bit weaker on the capacity utilization there, coming in at 76.8. So a little bit more space has been made in factories and the likes. The NHAB housing market index was out a little bit later as well. Not a big number, but I had the feeling that the market maybe wants to just get a broad overview of all the sectors as we go into the last Fed meeting of the year. That came in at 46, so unchanged over last month. Has been steadily rising, that number, so no waves made from that one. And just that business inventories number there, up 0.1%, so another positive number for that. Over in all the geopolitical crap, the EU is now prepared for the end of the gas transit deal with Russia through Ukraine. It says it has no interest in further Russian gas transit via Ukraine. They've secured other sources. That just opens the door. We know that Europe has been moving away from Russia from gas supplies. Not that it stops them getting it from other sources. Italy taking delivery of a cargo from Russia of LNG, so they're still buying stuff from Russia and having it delivered. But the big thing has been this transit through Ukraine, which is obviously at risk of being shut down, or we had problems with it previously due to the conflict going over there. But the EU seems to think that it's going to be able to cut Russia off from the energy network for the future. We'll see what happens with that one. Almost forgot that we still got a funding issue in the US and some cans to kick. That looks like it might be going through. I can't remember what the deadline was, but I think it's 23rd, 24th, something like that. So we're playing the same old game again. US House Speaker Johnson says we are almost there on stopgap funding. Kate, any other items you want to bring to our attention? Any comment on the data?
No, the thing with the Canadian, as we've been talking about it, is just that the political scene is not right. McClem stays dovish. There's nothing going for the Canadian dollar right now. So this number didn't really change it. We could actually argue, oh yes, the headline dipped under 2%, so it's another negative there. No, nothing's too special on the US data either. We had a decent retail sales. That was expected, by the way. So nothing really changing there. In other red lines, but that's more a stock market issue, I think. And but there is a potential of a big merger going on in the Japanese auto market. Nissan and Honda are in talks. Of course, there is I think it's Renault is the biggest Nissan shareholder. They may have a say in all of this, but it looks like we may have like a new whale in a new big auto manufacturer being created soon. So that may be one to keep an eye on the Nikkei about. And the other thing is actually I don't know whether we need to cry or laugh about it, but that Farage thing where he pretends that Musk he will donate 100 million pounds or so to his reform parties. Do we need to cry about that, Ryan?
I don't know. I'll laugh more than cry.
Yeah.
But yeah, he's certainly making waves. The new Labour government seems to be lurching from problem to problem. The budget's gone down like a lead balloon. All other sort of fiscal, financial plans are going down like a lead balloon. Promises being broken. The latest one being women's pensions, which Mr. Starmer, apparently in 2022, fully backed, and now he's gone backwards on that. So that's all happening. Yeah, it's not looking good. And at the moment, with the Conservatives in a mess, it's looking like Mr. Farage's reform may grow to be the second party in the UK from the Conservatives. So, yeah, there's going to be lots of political moves to happen next year. Not that it means much, because we've got 5 years until the next general election. But yeah, Labour have lost a lot of councils since they won the general election. They've lost a lot of council seats. They've lost by-elections, and that may continue if we get that sort of stuff, local elections next year. So, yeah, not looking good at the moment, but who knows? Yeah, Mr. Farage could be Prime Minister one day. What a thing that would be. But never rule anything out in politics, eh?
Yeah. Perhaps then I will revise my opinion about the sterling a little bit, if that would happen. But hey, who knows? I mean, if he's backed by Musk, I mean, who he's probably going to shoot for the stars himself.
Yeah, exactly. You know, why not? Why not? Mr. Trump got in again. Who'd have thought? Who'd have saw that coming 4 or 5 years ago? And here we are. Now, here's a trade I think might be huge next year. And I've been keeping half an eye on it, but Argentina, Kay, what do you reckon to a bit of a comeback for the old arse, shall we call it? There's a headline up here in the Wall Street Journal that Milei is looking to apparently eliminate currency controls in 2025. It's been a real interesting story watching what he seems to have ripped up the rule book, doesn't he, in terms of general economics and what he wants to do over there. It seems to be working. And,
yeah, I really looked at it in depth yet, Ryan. Perhaps I should, because especially for an emerging market economy and its currency, if things start to look up, let's say, or down, there could be gigantic moves coming. So it's perhaps something that we should be keeping an eye on as well. But I really don't know, because then you look at one of your trades for 2025, you say, we also have to look at how are they positioned versus the United States, because let's face it, 2025, whether we want it or not, is going to be in big parts decided by what Trump does and what the reactions are against it, or pro. I don't know what his stance is against Argentina, for instance.
yeah, and being out of trade, it'll be the other thing. So no one's even quoting it anymore, because the currency's all been lost.
Is it not like a non-deliverable forward also?
It's not tradable. But yeah, it could. If you could trade it, it might be one. But yeah, I don't know.
But you need a very good bookie. You need a very good bookie, because not many of the traditional retail brokers have an NDF offer. You know.
Yeah, we might have to pop over there for a holiday with a few empty suitcases. And yeah, do it that way. But yeah, I don't know if we're about to trade it, but it's been an interesting topic just to keep keep in the back of your mind and have a look at now and again to see what they're doing over there. As I say, he's ripping up the rule book, or trying to rip up the rule book, and if it works, then it could become a bit of a blueprint. But anyway, let's move on.
We lost you.
Oh, hello. Yeah, got me.
Yeah, I'm back.
Yeah, sorry. I was saying that's something just to keep an eye on, maybe next year, for just a bit of interest, just to see how he gets on. Right, let's look at something we can trade as opposed to something we can't, and that's the Fed later on today. We probably killed it to death. What expectations are, but we are at the the final moment right now. So I've not got any change in views on this one. I expect a cut 25 pips with a potential less dovish message and more ramping up of possible pausing, worries about this pickup in inflation if it becomes more persistent. Obviously, the economy is doing well, faces risks. We've obviously got the Trump effect as well. But I don't think Powell will want to get too much into the political side of things. He'll probably do a can kick and say we'll have to wait and see what policies come from the administration and how they are affected in the market and whatnot. What does the dollar do from here? I can't see euro dollar doing anything in this part, but maybe the market's just waiting on a confirmation that we are potentially facing the risk of a pause going into next year. So we might get a confirmation move on that. Do you think he's going to try and do his best to suck the volatility out of this one, Kay?
Well, if the market has done its thing ahead of the meeting, it's already auto-censored itself, because especially the euro dollar, you're looking at one of the weakest economic pictures right now, and the euro dollar is just stuck at 105. And the rest of the currencies has been relatively weak against, well, barring some exceptions all the time. But has been relatively weak against weaker against the dollar. So I'd say for this one, unless he comes up with a surprise, which would be the surprise trade today, in my opinion, is not as hawkish as he should be. But how can he, if you look at the data, how can he be more dovish than what we would expect if you look at the data? You're still looking at data zooming on quite nicely, bit of sticky inflation, labor market did not jump. There's no reason to be dovish, right? So I guess it's all there. If anything, it could be a non-event market somewhere if the market has priced it all in, because it should be 25 at a pause, and everything is doing well. And now we wait for his presidential orangeness to take the seat.
Yeah, absolutely. I think that's what's going to happen. He's going to try and kick the can, but he's got to acknowledge where things are at, and I think that is their big worry. Inflation has stalled. We've been telling you it's been stalling for months and months, particularly that core number. And this was always the risk that we didn't get down to target. Now, is it just a temporary blip, or is it something more entrenched? And if you've still got a pretty solid economy, then that's going to keep the inflation pressure there, because there's no reasons for anyone to start slashing prices. You're going to see that in Europe next year. We've already started seeing it in France with the PMIs. Firms cutting prices to try and attract business. That's where you really get a downward shove on inflation if everyone starts cutting prices, and that's not there in the US. So, don't know. Could we see a hike next year, mate, from the Fed?
Unless if they're forced to. I mean, if it's inflation based, it will be a forced hike. For growth, they actually are in an extremely good place for growth, because growth is zooming on somewhere apart from bonds now, because they are reflecting a bit this risk of more spending to be funded and things. It would be inflation driven, which is usually not a very good hike, but in this case, who will tell? I think there's so many uncertainties coming towards us, and for them. I mean, for all central banks now, because you're in the Fed and you say what is going to happen next year with the funding? Is Musk going to succeed to cut spending? Is he not? Because that's another question. There's so many uncertainties that in the Fed's case is, wow, will we have to hike? And where the other think about the biggest trade partners, they are wondering, are we going to have to go with bigger cuts, because global growth is going to get an absolute slap around the ears if he tariffs the daylight out of everybody.
Yeah, exactly. And it's obviously a forecast meeting, summary of economic projections, as they like to call it, the old SEP. This is a conversation I had with Mr. Brown earlier this week on our trade-off, and I agree with him. ordinarily the dots would be important in terms of where the Fed see the medium for rates. I don't think that's going to change much. Might tighten up a bit in 2025. I think what we're likely to see is just the spread of dots coming closer together. So where you obviously get people who are hawkish, and they'll be a couple of points above everyone else, and the doves will be a couple of below the medium. I think we're probably going to see a real tightening up to more to the median than a bigger variation in that. So I'm not expecting any big changes to the forecast themselves. As I say, the dots I don't think they'll probably feed into the hawkish bias a bit more than anything. But I don't know if they're going to be a bigger driver as they have been lately. You got any thoughts on those, mate?
Sorry, Ryan. I was just looking at something about the dots.
Yeah.
I think we may see so a repricing of the dots, if we can call it that way, closer perhaps to 0.5 to 0.75% for expectations next year, because we did have a few hawks in there. So and there could be a concentration. I don't know. Again, they're all wrestling with their own uncertainties, perhaps. But it could be, if they all concentrate around 0.5, 0.75, that would actually be for stability of markets not too bad of a thing, right? If you see a concentration, if it can create a move, but if all of them kind of agree on a concentration, it also has a stabilizing effect. So wouldn't be too bad a thing if they concentrate a bit today.
Yeah, I mean, forget 2024 because obviously with the
No,
last
of
month of the
course.
year, so it doesn't really matter. But it's going to be 2025. So we're probably going to see, as I say, some of these low ballers stepping up. So probably the medium's going to come in maybe round about there. If it comes in close to 4%, that will probably be looked at as really
Bullish.
hawkish. So yeah, probably those might stay, but all these bods down here might be stepping up a bit to this sort of area here. And then where they see the rest of them. So yeah, a bit of a squeeze. They look like Christmas baubles, these ones, but it might turn into a bit more of a long line along that sort of area. Right. So any other thoughts, mate? On
just looking at something that I've been telling people again yesterday as well. Look at the clock, guys. It's 2 minutes into the hour. And it does seem like sterling is all of a sudden coming bid here, and we could start to see those fixings show up. Okay, so we've got the big London 4 p.m. Of course, we've already seen two little examples of, and it is the way that I've been saying. Two little example of sterling coming bid, and now we are seeing it in the European morning as well, and all of a sudden sterling coming bid into the top of the hour. So keep an eye on that one going forward, because as we've been talking about this as well, sometimes at the end of the year, at the end of the month, quarter, but especially at the end of the year, you can see moves coming out of the blue. So do not be surprised if they occur. Okay.
Yeah, very much all in the quid at the moment, isn't it?
Yeah, and it's yesterday as well at 4 p.m. It was virtually only the pound moving.
Yeah. Okay. Yeah, I want to keep an eye on. Good spot, mate. Yeah, we'll definitely keep an eye on that. Cable guy in our room just says Musk has arrived at Farage's place, so it must be it. But yeah. Right. So price wise, looking around, I mean, I have no idea what it's going to do for euro dollar. This one looks real firmly glued. I can't even see the Fed break in this range at the moment. Wouldn't expect to test down to 104.5, maybe something a little bit lower if it's uber hawkish from the Fed. But conversely, this one might just be waiting to get over the Fed hump, get that confirmation that the Fed is going to be a bit more hawkish, and then maybe we're going to try the downside. Otherwise, we're stuck in this range. Keep an eye on this one. If we don't do anything over the Fed, keep an eye on this one for year-end stuff. Okay, if we can't do anything in the last month and a half down here, if we get a move that looks like it's year end stuff, then that's something you'll need to pay attention to. It's been sold off from the 112s, so there is maybe a bit of risk of some shorts closing up, seeing it move higher, but who knows? We just need to keep an eye on that one. So yeah, not looking for much in that. Ali, you were talking about dollar CAD. My views, mate. I said that said it on Monday. I think you had a good trade out of that. I was kicking myself for missing that because I had a buy stop in last week that I pulled down near the 142. So I'm kicking myself over that. But dollar CAD, it's really all about the big levels up here. And this double top that I've pointed out often enough. We've got a few bits and pieces might just be able to see them. Just pulling off some of these prior highs and levels, going back to these two spikes. So round about here, there's 143, 40, 50-ish, just coming off these weekly levels up here. It's a bit hard to see. You have to do a bit of scrolling and zoom in and whatever. Another one up, 145.5, but really it's all about those highs in the 147s. But while you've got this move going on here, it doesn't look like stopping, and it hasn't looked like stopping since it started going. Let's come a bit wider. Since it started going in October, this move has been something very, very strong. Let me go into the short-term charts a few levels. So 143 is looking like where the support has been building, particularly this morning. So that's your first level. Then we got this old 142.65, which is a level out of my chart for ages. We got up there, we held it, we broke it, we held it as support straight after. So that needs a consideration. Nothing really changes, at least if you just take this leg of the rally. Nothing really changes unless we're under 142, 141.5, or particularly that whole point 140.90. So this trend is still going, it's still solid. So if you've been running this one, well done. Just try and stay on it as long as possible. Yeah, you did well, Ali. You made some money, but my saying, don't give up a winning trade, even if you keep a little bit on just for interest, see where it goes. That can often expand your profits by quite some margin, those little bits that you just leave on and keep running. Okay, what's going on in dollar yen? We're pretty much in the middle of two levels here, 155 and 152s. Can you see
we're around
moves outside of that? Obviously, the BOJ focus.
We're around that 153.60.80. Get a bit of a FOMC move, then tomorrow a bit of a Bank of Japan move. I think, as you say, we're in a bit of a range here. And then it's going to depend on what those year-end flows will be, because we traditionally see some decent flows coming up in yen. I am unable to tell you what the direction will be. I mean, if anything, I would say perhaps slightly lower for the dollar yen, but I'm not going to bet on it, because we could have a bit of a disappointment if the Bank of Japan really keeps their hand still. We could have a bit of a disappointment rally there and tag 155 before even looking back. So yeah,
I was going to ask that. Has a hike now been killed dead? Given we keep getting
those reports about the speculators, more than 90% thinking that there is no hike coming. I'm still keeping the hike chances well over 10%. But as I said, perhaps not a 25. I think they could go for a 10, 15. There is reason enough to do it, because Ueda has told us. Then the rest is all about messages being sent out in the market about caution, and that really killed all expectations. But if you look at the dollar yen, if they would not hike at all, we may have already been trading. I mean, if the risk were zero, we may have already traded or are trading now 155, but it still seems that the market does not completely dismiss the risk of a bit of a hike. So
Yeah.
but then you look at the other side of the medal. What if okay, the Fed will do 25. You will perhaps have an algo move, then come back, wait for the Bank of Japan. What if they do 10 BPs? Is it going to be enough to put dollar yen under 150?
No,
Unless it's
no.
supported by year-end flows, I'm not sure, you know.
Yeah, and again, I spoke about this with Michael. I don't see any path where dollar yen comes out of this lower or meaningfully lower. Even if you just forget what the Fed do, obviously if they're not hawkish, yeah, we're going to see a dip in that. But then if the BOJ don't hike, dollar yen goes up. If the BOJ only hike a 10 or 15, we get a little reaction lower probably, and then it goes up. If they go a 25, it's very unlikely that they signal they're going to go another 25 after. So you get a dip on a 25, and then probably comes with a pause that, they need to see what Trump's going to do, and then they're going to be waiting for the next round of wages. So the market's going to go, well, the earliest you're going to hike again is April, May next year. Dollar yen goes up. I don't see any path where this goes down. Year end flows aside, possible year end flows aside, I don't see any pathway where this goes lower.
Well, I mean, let's put it in another way. If the year-end flows put this thing much lower, I think I may catch a knife, especially
Yeah,
for the start of next year. But we first need to know what they are, and it's again the case as I've been saying for so long. You get those big drops, fast moves in the dollar yen, and then look where we are. We are 5% below the all-time, or not the all-time highs. I'm sorry. I mean, those who were in the markets 45 years ago, they know dollar yen was trading at 300 then. But yeah, and that's where we see exactly the impact that I spoke about at the start of the year. That the Bank of Japan will go slowly, and even if the other ones cut, there will still be a differential, and there will still be. Obviously, it's been helped also by a very good, barring bonds, a very good US asset market this year. And the Japanese still needing to put their money to work. But that were the reasons why I was saying at the start of the year, I said, like, I doubt that we are going to go much lower. And when we were at 142 at the first face show of the year, and I said we're probably going to end the year higher. So far, so good, because that is exactly the scenario that has unfolded, even after that big drop that we saw in August, which is arguably a lot of people pin it down to the Bank of Japan, but it's not only the Bank of Japan, and we know that. Uh,
yeah,
and yeah, I agree with you. For if tomorrow they hike, but they announce a pause, what is really the reason to continuously buy yen? You know.
yeah, exactly. And we've been talking about it last couple of weeks, and you've got to be ready for it. Okay, once we get over the Fed is a big hurdle. Okay, in terms of what's going to happen at the year end, into the holidays and whatnot. We're all trading what the Fed's going to do today. After that, the market is effectively off the leash in terms of the fundamentals. Okay, so if there are going to be big flows and whatever, it's from tomorrow that we're going to start potentially seeing them. So this is where you need to match the moves against the fundamentals. Okay, if we know that the Fed is going to be a bit more hawkish going into 2025, if we know the Bank of Japan hasn't hiked or has got a small one or whatever, we know those positions. Okay, then you look at any big price moves. If we get big price moves that move things out of kilter, like a big sell-off in dollar yen, you've got to look at those moves and think, that's year end. Does it match against the fundamentals? And you apply that to every currency you see. We have had some big, huge moves at year end, and even the early part of this of the New Year's, we've had some big, huge moves, and you've just got to. You can't get sucked into, dollar yen's collapsed 300 pips, that's it. That's the end of the bull run. It's heading down to 130. You get sucked into those sort of things. That's how you lose money. Okay, so we are going to change tact after the Fed, okay, in terms of how the markets are potentially going to trade. Be ready for it, okay? Don't be sucked in and don't get spooked by some of these moves, okay? You've had the warnings long enough. No one should be caught off guard with what you may see over the next few days, at least. Right, Kate, I'm going to bounce it over to you, mate.
Yeah, just a last word on that, and
Yep.
I always come back to the same thing. Keep an eye on the clocks, okay? Keep an eye on the clock, because most of the time you will see those year-end or flows that people need to do. You will see them starting ahead of fixings or so. So always keep an eye on the clock. It's going to be a very hard time to stand in front of trains. You better ride it for a couple of stations if you want to. But also keep in mind that all of a sudden, after a certain fixing, say for instance the 4 p.m. London fixing, there may be a vacuum in the market, and all of a sudden the market flips around and then says like, oh well, okay, this was a market, this was a move against the fundamentals purely fixing driven, and all of a sudden you see a move to the other side. So, or a continuation, depending. But so don't be surprised about anything, right? And we've been talking about that long enough, and also. As Ryan rightfully said, perhaps all those year-end flows have been waiting a bit to really hit the market until we get over this FOMC. I've also been saying that, and that makes year-end flows even more dangerous, because where last year we saw violent moves, but they were spread over a very long time. Here we could see a 3-4 trading days heavy concentration of those flows if they need to be done. So really be ready for them, and don't be surprised about virtually any move that may pop up. Okay, what are we looking at? Well, first of all, yeah, I still want to keep an eye on the cable, okay? And we've seen it again. I'm going not to go into too short term, because the bigger picture is still roughly the same, okay? It's still 126, figure 10, around there to me, which is the level, and now we are getting closer again. This 127, 30, 35, okay? We're getting closer again now. Remember what we told you, those flows, okay? So there is a potential that we are going to have a look, I think, to test them, perhaps even a bit higher, if we see more of the same thing that we've seen over the past couple of days into the London fixing. And then be very careful, because the story may or the song may be over for a little while until we get into the FOMC, and we can go all the way back down to 126s. But I think if we get out of the FOMC with let's say already cable above 127, 30, 35, but especially above 127, 60, 65, ahead of the Bank of England already, it may mean that we are going to push through. This is still somewhere, as I've been talking about it for quite a while, this is still somewhere my preferred side of it, going into year end, just based on some very simple modeling, okay? Equity market divergence and stuff. And again, as I was showing yesterday, 82, 50, 60 is a bit of a level that euro sterling is wrestling with again right now. That perhaps a bit heavy cone in the weekly. Is again a bit wrestling right now, and this trend line is starting to get watered down. I think we should rather put it there somewhere. But I haven't given up, and we also see regularly it's in a range, but seemingly every fixing is bringing it a bit closer to that big zone. Now that the difficulty for this is going to be making a distinction between what are year-end flows and then what's going to happen in the new year, because there may be even a break coming if the flows are big enough of this one. But I am not going to say that the break is on of those really, really big levels in the euro sterling before we start the new year right now. It's a bit too dangerous to call the break. It can be the break, and we are going down to 79, but I'm going to say it is going to be dangerous to call the break if it's on the back of year-end flows, because the snapback come the 2nd or 3rd of January can be equally violent, and we can be trading right back up to 84s. Why not? So be a bit careful, but I do think that we may be heading for a weak close of the year of this euro sterling. So what else are you guys looking at? Remember yesterday I said about the sterling Swiss. We came back to test it even slightly below this morning. But if there's not and on the tip of my toes, because it's really Swissy. We have seen that violent move at the end of last year as well. Uh, but if there's nothing specific or special really to do big flows in the Swissy, I still think sterling Swiss could be one, also based on fundamentals, based on central bank divergence, could be one to end the year a bit higher again. Yes, the sterling CAD. We looked about this on this yesterday. Yeah, this is a bit of a longer term. And if you look at the troubles that Canada is having right now, we are through those prior highs here, September, October highs in the sterling CAD. Actually, yeah, we are through, and this looks to me to be pushing up as well. Unless there is some surprise in the Canada into year end or so, I don't know. But the Canadian really looks weak, and this sterling CAD. Keep an eye on 181.5 the range. If we start to get back below, then it could signal that we may have seen a little bit of a forced rally here and come back down. But the trend is also your friend, and I wouldn't be surprised if this thing trade up to somewhere around 184, and when, well, 186, 187 is high, but we never know on year-end flows. We never know. It could really reach for the stars if that's the direction of the sterling. You asked to look at silver. Well, the picture hasn't really changed much. We had the test of the underside of the box here, the top side, sorry, of the support box, Ali, and it's held. So that's yet another confirmation that this box is important enough. Okay. I saw you talk about what can happen in 2025 if wars end, whatever, but that's part of all those uncertainties about what's going to happen in 2025. Okay. As well, gold as silver will be impacted. Of course, it should. It should, because if you don't get in, if you stop wars, and if you assume that somewhere perhaps the tariffs against China also may not be as tough as expected, gold will drop. Gold will really drop, because there's no reason for this to stay up there. If you don't have any real wars or trade wars coming, this you don't need the hedge, right? And this could really drop. In contrary, if you have a better global economic picture deriving from the end of wars or no trade wars, silver should outperform gold, because that means that if the global economy, and I've been saying that already a number of times, if the global economy, and then think about especially US and China, if we get a Chinese revival, silver should really be underpinned, and we may start to move higher. This, regardless what gold is doing, they could completely decouple those two if we get such a scenario. And I think we've given all our points of view here, Ryan. That's enough for me for today, mate.
Yeah, thank you very much, mate. Yeah, we're certainly done and dusty with the Fed and whatnot. Don't forget, you can come and follow us on Face, and you probably hear the same thing all over again when the Yanks get in. But otherwise, take care over the Fed tonight if you're staying up and trading it, and then the BOJ tonight as well, early tomorrow morning. Trade safe when we'll go over what's been said and done tomorrow on the Flow Show. So join us then. Thank you very much as always, Kay. Thank you very much, boys and girls. We'll see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.